The Fed just cut rates. That usually makes markets happy. But this time, it's complicated. Inflation is still high, jobs are disappearing, and Warren Buffett, the greatest investor of all time, is doing the opposite of what most people expect. He's holding over $340 billion in cash and short-term T-bills. That's more than the Fed itself. No big stock buys, not rushing in, just waiting. And that raises the question, if even Buffett's playing defense, what should you and I be doing? Now, you might say, Buffett's a billionaire, what should I care? Fair question, but when money that big steps back and gets paid to wait, it's a signal. This is migration. Smart money is already moving, and if you miss it, you'll be left holding the bag. Let's talk about what this means for us. Rate cuts do more than lower borrowing costs. They change where the money flows. And right now, big money wants three things: safety that pays, steady income, and protection from rising prices. That's why some capital is sitting in T-bills and cash. Some is moving into value stocks and dividend. Some is chasing real assets like gold and energy. So the question isn't why Fed cut anymore. It's where does your money work the hardest after the rate cut? Because we're not in normal market. We're in stagflation. Prices are sticky, jobs are slowing, and the dollar is losing strength. This is when smart money rotates. You just need to catch the wave. Today, I'll break down 5 places where money is flowing next and how you can ride along without chasing the hype. Let's come back to Buffett for a second. Rate cuts are here, but long-term yields are still rising. The top 10% of stocks now make up nearly 78% of the market. That's even higher than during the dot-com bubble. And Buffett's response? Sit tight. $340 billion in cash and short-term T-bills, no buybacks. He even exited BYD, one of his long-time positions. His message is very simple. Be patient, get paid to wait, and lean into real assets. So if you're looking to follow the smart money, don't chase every green candle. Focus on quality, be picky, and stay calm. Now let's turn that into an actual plan. Here are the top 5 places your money can work the hardest next and how to play them. Number 1, we have the metals, gold, silver, and also the miners, the money shield. Gold and silver are your money's shield. When the Fed cuts, but prices are still sticky, the dollar often weakens, and metals tend to lift. We've seen that this year, and I called out the gold move in the newsletter with the exact levels I'm still watching. Here's how I actually played. I like broad metal funds like GLD for gold and SLV for silver. If I'm aiming for more upside, and that also comes with more risk, I'll layer on more miners like GDX or a couple of big liquid names like NEM and BTG. And for the long game, I'm a fan of owning physical gold. It's simple, it's boring, but over time, it does its job. And quick heads up, metals tend to hold up better when markets dip, but miners are a wilder ride. The more miners, the bumpier it gets. So keep it balanced, match your position size to your risk tolerance, and don't overload. If the market pulls back, metals might catch a bit, but miners usually drop first and bounce later. That's 1 of 5. And the other 4, just as strong, maybe with higher upside. But before we dive in, you might be wondering, who am I and why should you even listen to me? I'm an actuary by trade. For over a decade, I've analyzed and forecasted more than $150 billion in revenue for Fortune 100 companies. Today, I run my own firm focused on business intelligence, risk management, and AI. The same risk-focused mindset that I used in the corporate world, that's how I trade. No hype, no magic signals, just data, discipline, and setups that actually make sense. And if you want my full trade setups, technical levels, and macro breakdowns, that's all in the free newsletter. I send it out a few times a week, and the link is below in the description. Alright, let's keep it rolling. Let's move to the next play. The second place smart money is heading right now, it's energy companies and pipelines. The cash that keeps coming. We all use energy every day. Pipelines are basically the toll roads for oil and gas. They collect steady fees, and a lot of those fees move higher with inflation. That's the kind of dependable cash flow that Buffett loves. Here is how I would think about it if I were building this now. Start with a mix of strong producers and fee-based pipelines. Producers bring more upside, but also more risk. They swing with oil prices. But the pipelines, they're more stable. They collect steady fees and those fees usually climb with inflation. Personally, I've been in Oxy, and Buffett is in it as well, and I've kept eyes on the big players like XOM and CVX. On the pipeline side, I would look for large investment-grade names where fee revenue stays solid. I've broken down those oil rotations and setups in recent newsletters. And also heads up, if crude oil sells off, producers usually get hit first and harder. Pipelines can hold up better, but they're not bulletproof. Volume drops or tighter credit can still shake things up. Now, on to number 3, uranium and nuclear power. The electricity that never sleeps. Nuclear power is one of the only energy sources that can run 24/7 without skipping a bit. And to keep those reactors running, you need uranium. And here's the kicker. Uranium is in very, very short supply. Now here's why this matters even more right now. Rate cuts make it much cheaper to finance big nuclear projects. And policy just added more fuel to this. The US and UK announced a civil nuclear pact to speed up approvals and roll out advanced reactors, including a $15 billion in SMR-powered data center projects. The US is also moving to expand a strategic uranium reserve to secure fuel. Pair that with countries extending and adding reactors, and you've got real, durable demand for nuclear power. And of course, uranium. And here's the connection no one is actually talking about. As AI explodes and data centers pop up everywhere, power demand is going vertical. All those chips need juice, and nuclear is one of the few sources that can deliver clean, constant power without the weather getting in the way. So when you hear about AI, think uranium too. If I were building exposure here, I would start with the URA, which gives you broad coverage across uranium miners. It's been my base position for years, and I flagged it back when it was trading way lower in the newsletter. If I'm reaching for more upside and I'm okay with more risk, I would look at select names like CCJ and NXC. I traded Oklo earlier this year, a tiny company working on next-generation nuclear technology, and I shared the full setup in the newsletter. Since then, the stock has surged nearly 200%. Also, quick heads up, uranium names are very volatile. They can drop hard in a sell-off and sometimes faster than the actual market. So I would scale in gradually, size the position based on your risk tolerance, and always have your exit plan in place. Now, number 4, AI power and copper. AI has been the headline grabber lately, and we just talked about how all those chips and data centers need a serious power upgrade. Nuclear power can deliver that clean, reliable electricity, but generating it is only half the story. You still need to move that electricity to where it's needed. That means big power lines, substations, and a lot of wiring, and that's where copper comes in. Rate cuts make it easier to fund that kind of infrastructures. The power stations, the wiring, the gear, all of it. If I were building copper exposure today, I would start with something like FCX. It's a go-to for copper miners. Then I would look at the grid infrastructure side, the companies building the actual stuff that makes power delivery happen. That's ETN for power gear, MVT for connectivity, and PWR for laying the lines. These are your picks and shovels. And if you're looking beyond the US, GE Vernova, ABB, and Schneider Electrics are solid names to check out for global exposure. Quick heads up, copper miners tend to be more volatile because they follow growth trends. On the flip side, the companies building the gear and laying the lines like ETN, MVT, and PWR usually hold up better since they've got long projects backlogs. But even they can get hit with new order slowdown, so stagger your entries, keep your sizing in check, and don't go all in at once. And finally, the last one. Number 5, dividend, growing value, and insurers. This is basically get paid to wait. Buffett is all about getting paid while he waits, not chasing the next hype train. And this is the kind of environment, dividend, growing value stocks, and insurance that fit that mindset perfectly. Let's start with the insurers first. When long-term yields push higher, like we're seeing right now, they actually benefit. Why? Because they earn better returns on the big portfolios they manage. That's why I've been watching and investing in names like Centene and United Health. They're built for this kind of setup. Now, on the dividend side, think stable income while you wait for upside. I've built positions in Verizon and AT&T, and I'm currently watching T-Mobile as a potential add. If you want a simpler, hands-off way to play the space, you can look at dividend growth ETFs like VIG or SCHD. They give you broad exposure without needing to stock pick. For more upside, and yes, more risk, I would lean toward companies that aren't just paying dividends, but are also consistently raising them and buying back shares. Think names like Lowe's, Texas Instruments, or Home Depot. Just make sure their balance sheets are solid. Too much debt or an unsustainable payout ratio can turn a good income play into a value trap. And one heads up, these names usually hold up better than high flyers during the sell-off, but they're not bulletproof. Dividends help cushion the fall, but if the market drops hard, this will still take a hit. So watch for signs of over-leverage or stretch out payout ratios, especially if you're reaching for yield. These 5 areas, they're where the smart money is rotating after the rate cuts. But the path forward still depends on what happens next. Think of it like this. The setup is in place, but key reports like jobs, inflation, and earnings can tell us if these trades have more fuel or need to pause. That's why timing still matters. And that's what I break down chart by chart in my free newsletter. The link is below. Now let's see what's coming up for next week. On Monday, we have pending home sales. On Tuesday, we have Case-Shiller home prices, job openings, consumer confidence. On Wednesday, we have ADP employment, ASM infrastructures, and auto sales. On Thursday, we have jobless claims and factory orders. On Friday, we have non-farm payrolls, unemployment, and ISM services. On earnings front, the only important name is Nike, and it's on Tuesday. To wrap things up, the cuts have landed, but what happens next is where the real opportunity lies. Buffett is not jumping into hype. He's playing defense and waiting for the right pitch. The 5 money flows we just walked through, that's where serious capital is rotating into real assets, steady income, and quality names. And if you made it this far, you're already thinking more clearly than most. If you want to go deeper, all my charts, setups, and trade ideas for next week are in the free newsletter. I break down key levels, technicals, and my thinking behind each move. You'll also get access to my free trading tools when you sign up. So check it out, the link is in the description below. Now, a question for you. Which of these 5 areas are you leaning into? Gold, energy, or dividend plays? Drop a comment below. And if this video helped you out, hit like and subscribe so you don't miss out my next upload. More great content is on its way. Thanks for watching, and I will see you in the next one.